Welcome back to the fundmonitors.com Manager Insight series. I'm joined today by Richard Ivers. Richard is the Portfolio Manager for the Prime Value Emerging Opportunities Fund. Richard, thanks for joining me today.
Thanks, Damen. Thanks for having me.
Richard, we've seen now 11 consecutive months of positive performance until the month of September just gone. The ASX 200 Total Return Index down 1.85, the Small Ordinaries Index down a little bit more than that. What do you think has been, some of the reasons why the market's been so buoyant for such a long time, and what do you think some of the catalysts were for the correction, albeit a small correction, that we've seen in September after such a strong market?
Yeah, look, obviously post the downturn of last year when COVID really hit in February and March, we saw vaccines being rolled out at the end of 2020, economies opening up more in the Northern Hemisphere, and then stimulus in the terms of monetary and fiscal side. So when you put all those together, they were really ideal conditions for equities, strong growth and strong stimulus from fiscal and monetary side. So that was really the real driver of markets on the upside. And then more recently, we've had some of that revert a little bit. So, the prospect of fiscal and monetary stimulus, well, it still will be there, probably there at a lesser extent than it has been, particularly in the US, which is talking about tapering and potentially interest rate rises next year. So, that's quite a fundamental change. And then there's obviously concerns too about inflation and particularly the duration of it, because there has been heightened inflation more recently, but there's been a view that it may pass relatively quickly. Now, some people are thinking that it may stay around a bit longer. And therefore, that's feeding into rising bond yields, which impacts valuations. So as always, the market's forward-looking, and there's a lot of different views out there about growth and inflation, and those are having an impact. And then you've got some of the other side issues like, what's going on with China and Evergrande, and a falling iron ore price as well, which are more specific to Australia. And our exposure to China that have affected our market as well.
Your fund, again, outperformed the falling market in September, and you have quite a long track record now of avoiding a lot of that downside risk. What's unique about your process that helps you avoid some of these sort of market corrections?
Yeah, so as you said, Dan, we're down we're almost basically flat in September, and the market was down roughly around 2%. Depends on which index you look at. And that track record, it's almost 3 years now where we've outperformed every month in which the market falls. So, and that's against the Small Ordinaries Accumulation Index. So that's quite an unusual track record, I think, particularly given that we're a long-only fund. And in terms of your question about why we get that strong performance in down markets, there's really three key reasons. And the first one is we invest in quality businesses. So, we're very much focused on businesses where you have visibility of earnings growth and the price at a reasonable basis. And so therefore you've got a fair idea of where the share price will go based on them delivering to expectations. We also avoid a lot of the more risky areas. So most of the companies, nearly all, it's quite rare that we invest in companies that are losing money. We don't invest in mining either, so that's a relatively more volatile part of the market, although it's been performing well lately. And we're not interested in sort of lottery ticket type businesses either, which, you could win big or you could lose all your money. And those areas tend to fall more when markets decline. So when risk appetite declines in the market, the appetite for these riskier businesses obviously falls as well. So, the cream rises to the top and we tend to perform better. At the portfolio level also, there's a strong focus on risk management. So the highest weightings in the portfolio are the businesses that tend to have a lower risk. So, there's some that do have risk in a reasonable level of risk, but they'll be a very small weighting. They might be 1% of the portfolio, whereas, the more visible, lower risk businesses where you've got a more certain return, the upside might not be as great, but the certainty of the return is higher. That will be a higher weighting. That might be, say, 3 or 4% of the portfolio, or even higher in some cases. The importance of downside protection is you can be represented in an illustration. So say if you have $100 and you lose 50% of that, you've got to get 100% return to be made whole. So you have to go from 100 to 50, you need to get back to 100, you need to double your money again. Whereas if you have, say, a 25% loss from your 100, you go down to 75, you only need to get a 33% return to be made whole. So having that higher platform to which to grow when markets rebound gives you a really strong basis from which to perform well. So even though we've got really strong returns in down markets, we haven't foregone good returns in up markets either. So if you look at the last 12 months, when markets have been strong, as you highlighted, we've delivered 36% net after fees against a market index that's done 30%. So you're not foregoing, the upside in bull markets either. You're actually getting the best of both worlds, if you like. But we are particularly strong in down markets.
Now, I think, before we jumped on camera, we were talking about continued lockdown and the effect it's had on my hair. But it's also had an effect on a lot of companies, in Australia. What do you think, with restrictions starting to now ease, what sort of sectors do you look at with those restrictions easing as being potential opportunities?
Yeah, absolutely. But I would say that it's been foreseeable for some time that this was going to happen. So it's not as if we're changing the portfolio around just recently because now that the reopening is happening. There was always an expectation that would come through with the vaccines being rolled out. So we've held a number of stocks in the portfolio that are beneficiaries of reopening. A couple of examples, which I've spoken before, I think, to you about, City Chic, which has seen the stock perform really strongly on the back of strong sales, particularly in the Northern Hemisphere, because it sells apparel, or particularly female apparel, into the Northern Hemisphere as well as Australia. And so with the reopening there, it's been, it seems sales go really, really strongly. The share price has responded. And another one like United Malt, which is we still own, which it's seen an improvement, but Delta has delayed the extent of the improvement a bit, and so the share price hasn't performed quite as well. Still done all right, but hasn't performed really strongly. So we still hold both of those, and we've held both of those for some time. In terms of changes to the portfolio, it's funny you might frame the question in terms of the reopening, because the ones we've actually been buying more recently are the ones that maybe aren't even necessarily beneficial so much. So they're more defensive areas of the market. So sectors like healthcare and consumer staples, there's a couple of stocks in those two sectors that we've been buying recently. And that's really just because of stock-specific factors. So the volatility that we're seeing in the markets opened up some really good buying opportunities, and the businesses we've been buying, we have a relatively high certainty of where those earnings are going to be, and they're pretty attractively priced as well. So they're defensive, and they should be able to grow regardless of what circumstances are in the economy, which is the ideal sort of stock that we want in the portfolio, where we're not relying on the cycle to give them a tailwind. They'll grow for their own reasons and their own structural drivers behind the business.
Richard, I guess another question I've got is that having now managed a portfolio investing in small cap Australian stocks over a period where things like management company visits and those sorts of things have been really, really difficult, with the easing of restrictions and through vaccination, a potential change in how you do business. Do you think the last 2 years is going to have any future influences on the way that you, I suppose, approach how you deal with companies and those sorts of things? Do you think you'll go back to the way you used to do it, or has this given an opportunity for you to get greater amounts of coverage by doing it in a more remote sense?
Yeah, no, it has helped absolutely with Zoom and the like we're doing now. In terms of accessing management, you can fit many more meetings into a day than we could pre-COVID. And travelling is taken out of the equation. You can do it, but I don't think meeting by Zoom is the same. I think we're probably all looking forward to sort of meeting face to face, and I think you get more out of a meeting face to face. So we'll definitely go back to a lot of those meetings. Perhaps the ones where you know the company well and you meet up with them reasonably regularly anyway. You don't need to always meet face to face. You could do some of the infill by Zoom, but meeting new companies and perhaps when you're coming up to speed on a business and doing a lot of in-depth work, I think face-to-face really can't be replaced by Zoom. I think that's it's still the human contact and the conversation. You get a feel for a person when you sit down and meet with them face-to-face.
Yeah, absolutely. I think certainly in a funds management sense, seeing the whites of their eyes of the management team has always been a significant advantage. Richard, as always, thank you for your time this afternoon, and good luck for what's left of 2021 and on into 2022.
Thanks, Damen. Thanks for having me. Cheers.